Good evening, everybody. Happy Thursday. Welcome to our final webinar of 2022. Hard to believe it's here. Merry Christmas. I hope you've got some good plans ahead for the days coming up here on the holiday. Thanks so much for joining us on this Thursday evening. We've got some exciting news to share with you, a couple things to kick off the end of the year here. And glad to have my partners, John and Adam, on the call. Thank you guys for being here.
Good to be here, Robert. I think one of those exciting things,
we decided to spread a little Christmas cheer. So we got the red vest, and Adam's really kicking it up a notch with the bright red jacket.
That's right.
So we figured, it's Thursday, holiday coming up. We got to do something to shake it up a little bit. So anyway, but we do want to talk to you about some tax opportunities, end of year tax opportunities. And then also we've got one deal that we've still got a little bit of space on that we're trying to wrap up by the end of the year. So figured it'd be a good opportunity to kind of tie the two together. So without further ado, we'll jump into what we've got here. Now, I know some of you guys on the webinar are a little bit newer. You may not have been on one of these webinars before, and we're glad to have you. Always great to have new folks on the webinar. But for those of you who may be a little bit newer and haven't gotten to know us as well, just a quick summary of who REM is. We cover about 7 states throughout the Southeast, Midwest, and Texas. We are a multifamily value add focused investment shop. We really focus on the value add opportunities in the workforce housing space. And we are currently about 120, 130 people in our total company with management, construction, asset management. And we've got a picture there that we just took from our leadership conference. Last week, we spent a couple days here in Sarasota, Florida, and got everybody together for some training and obviously get to know each other because we're all spread around a pretty big area. We are, our focus is really pretty simple. The right people running the right deals. And we like to keep it that way because that keeps us focused on what we're really all about. So we really like to spend the time to develop and train all of those inside the company so that we can continue to carry on the mission and the vision that we started almost 5 years ago now when we started REM. So that's a little bit about us.
Robert, who was the oddball in the front not wearing an REM shirt?
What's that?
Who's the oddball in the front not wearing the REM shirt in that picture there?
Yeah, I don't know.
Oh, wait,
I think
that's you. My bad.
He's probably going to get written up on the next review, I'm guessing.
disciplinary actions.
Yeah. You always got to watch those people that just can't seem to comply with company policies. So as I mentioned, we cover 7 states, 3 regions, got about 3,500 plus units. I think it's closer to 4,000 and about $500 million in assets under management. We got some pins there on the screen to kind of show you where we're at. And we are really focused on those areas for a couple primary reasons. There's a lot of population and job growth in those areas. And there's also some really good yield in those areas as well. The Midwest is a little bit better yield. Southeast and Texas, a little bit higher job growth and population growth. However, one of the things that we've found over the years is that there are unique markets that may be somewhat overlooked that do have quite significant job growth and population growth. They're just not as prevalent as other areas. So an example would be Florida. Obviously, everybody knows people are moving to Florida. It's kind of a foregone conclusion. You can almost throw a dartboard and invest something in Florida and probably do okay just because of the growth. Whereas in the Midwest, you actually have to know your market a little bit better. But there are growth markets in the Midwest. In fact, our first deal that we did 4 years ago, almost 4.5 years ago, was in a town outside of Dayton, Ohio. And that particular deal has performed really well. In fact, our rents are up about 65% from when we bought it. So again, There are great opportunities all around the country. And we tend to focus on these three regions because we really like them. We also focus on areas where we feel like it's landlord friendly, because again, obviously we're in a business to ensure that our residents pay rent, and some states are not as pro landlord. So a little bit about our model. We like to call it a risk-based investing model. And there are 5 components that we've delineated that we feel kind of explain that. And really they boil down into the difference between a higher risk versus a lower risk investment. So a higher risk would also generally give you a higher return, which we show on the left there. You might risk 100% of your capital to get a 30% return. Good return for sure. What we're more aiming towards is risking 10% or as low as 0, as little as possible to get a 15% return, which is a good return. So our model is a little bit different in that respect. We're a little bit more focused on cash flow. We're a little bit more focused on long-term appreciation, and we like to take lower risk. But on the flip side, there's also some significant tax advantages and tax efficiencies that we also build into our investments. And we'll talk a little bit more about that tonight. But one example that I like to give is if you've got a investment that, let's say it returns 20%, but you've got to pay 30% taxes, you're going to end up with somewhere, 14% plus or minus at the end of the day. On the flip side, you could invest in something that returns 16% and you don't pay any taxes. So at the end of the day, the 16% that doesn't pay any taxes is a couple points ahead of the 20% that pays the full boat. So there's some nuances to think about. We always think about what's the bottom line money in our pocket at the end of the day after paying taxes, because that's kind of an important number. So with that being said, like I said, there's 5 different components here that we really focus on. One of them is stress testing, and that's a simple term for taking certain elements of our model and pushing them to the limits. So for instance, all of our deals, we like to stress test our occupancy down to 70% to ensure that in a really, really worst case scenario, we can still pay our bills. And that's something that we feel is above and beyond the industry average for a stress test. In most downturns, if you look back the last 2-3 downturns, the average occupancy settled out about 88%. So in other words, a 12% vacancy at the bottom of the market, at the bottom of the recession or whatever it was. So we're going all the way to 70% as an extra caution. So that's just one stress test that we run. There's a couple others that we do too. But again, those are the kind of things that we feel are important to make sure that our investments are lower risk. We also like to identify the risks in the market and then mitigate them. There's kind of 3 primary risks in our business. There's cap rate risk, which is kind of a fancy term for saying valuation risk. There's also interest rate risk, which of course right now we're facing some of that with the rising interest rate environment. And then there's also market risk or economic risk, simply meaning, how is the country doing as a whole? How is my metro area doing? How is my individual sort of neighborhood doing from an economic standpoint? So our goal is to identify those risks and mitigate them as much as we can. So again, that's something that we consider very important when we go into a deal. And just as an example, from an economic standpoint, as I mentioned before, we like to really do our homework to ensure that the areas where we're investing are economically resilient. So they've got good job growth, they've got good population growth, income growth. These things are really important to ensure that that investment is going to last for a long time. The third component is lower leverage. It's kind of a no-brainer, and I don't mean to oversimplify it, but lower leverage generally lowers your risk, generally speaking. Now, we don't want to use no leverage because we would consider that inefficient use of capital, but we also don't want to use too much leverage. So in my experience over the decades in the business, I've come to the conclusion that somewhere in the 60 to 70% range is a good conservative leverage ratio where you're getting the benefit of your lower cost debt, which is obviously cheaper than equity, but you're also not putting too much stress on the property that would allow you to potentially be in a high risk situation if something happened to the economy. So lower leverage is an important component too. The fourth element is industry expertise. We believe it's really important to have a lot of industry experts on the team, folks that have been in the business for many years. know the ups and downs in the industry and the economic cycle, and also have the ability to kind of predict what's coming, all the way down from, how do you turn a property around from a leasing standpoint to what's going to happen with the interest rate environment? How do we protect ourselves? So we really believe that industry expertise is important, and it really pays off in lowering risk. And it's one of those things that I would consider almost an intangible risk element, because you don't really see it immediately. It might take years to really understand how that lowers the risk of your investment, but it really does. And again, having been in the business for many years, I've seen how real estate investment shops that do have industry experts, they generally turn out a more consistent return because they're able to manage risks better. So that's our fourth component. The fifth one is conservative underwriting, which we will get into a little bit more specifically. But in general, it's basically just saying, hey, if we think that the rents for a particular property could go to $2,000 a month, why don't we underwrite it to $1,800, maybe $1,700? Give ourselves a little bit of fudge factor. Make sure that we're not over-promising and under-delivering, just as an example. So those are the kind of things that we feel like give us, again, that lower risk, good return scenario, and really help to define how we build these models into each of our deals. So I hope that makes sense. So with that said, let's jump into kind of what we're going to talk about tonight, which is really twofold. One, depreciation, which we've had a lot of questions about, and this is the last year that we can receive 100% bonus depreciation that will get passed through to investors. And then the second thing we want to talk about is the one opportunity that we do have left for this year that we actually purchased about a month ago. So I want to tell you how that's doing and also let you know about that opportunity. So what is kind of the first line when it comes to depreciation? What's your standard depreciation? Well, and it's been around for a long time. So kind of the standard depreciation is essentially you take the cost of your property and you back out the land value, because land is not depreciable. And for those of you who may be newer to that term, depreciation essentially says, hey, depreciation applies to something that needs to eventually be replaced. So eventually, all buildings and anything inside the building eventually has to be replaced. And so the IRS recognizes that and says, okay, we understand if you own that property for 27 and a half years, you're going to have to put a lot of work back into it. So we're going to let you depreciate the investment cost that you placed on the property initially. So that's our standard depreciation. It's you take the acquisition cost minus the land value divided by your depreciation period, which for residential properties, which the multifamily residential is 27 and a half years. So prior to I guess, well, not even 2017, it goes back even further than that. Prior to that, it was a very simple calculation. Now, again, you got the benefit of that depreciation, but it was fairly minimal and not as material as it is today. So that's sort of step one, is standard depreciation. Step two, which we are able to do, is something called a cost segregation study. Now, a cost segregation study says, well, let's think about this for a minute. Is every single component in this property really going to last for 27 and a half years? Probably not. In fact, we know that we have to replace carpet, air conditioning units, roofs, all these other things much more often than 27 and a half years. So the cost segregation report allows us to hire an engineer, go out and break down the components of the property into its class life period, and then take that back to our depreciation and get more depreciation by doing that. And as we mentioned down below, we've got these different class lives. There's a 5-year class life, a 7-year, a 15-year, and then the 27 and a half year. So obviously, if you take something and you depreciate it over 5 years, you're going to get more depreciation in each of those 5 years versus 27 and a half years. So that was kind of step two in beefing up the ability to take depreciation. Now, step three, which really took this to another level, was what's called bonus depreciation, which has been around for a while, but it didn't always apply to commercial real estate class life periods. And this bonus depreciation, which was kind of accelerated back in 2017 with the Tax Cut and Jobs Act, allows us to take 100%, meaning take the entire depreciation amount for anything that is 20 years or less. So if we go back just one slide here and you look at the class life, you have 5, 7, 15, and 27 and a half. So basically anything that is not 27 and a half years, the IRS or Congress said, hey, you can take 100% of the value of that asset and write it off in the first year when you buy it, when you place that building in service. So that's been a phenomenal benefit to real estate investors for the last 5 years. 2022 is the last year that we are going to be able to get 100% bonus depreciation, which is great. And again, that's been a huge bonus here. Now, it's not going to go away immediately. It is phased out over the next 5 years. But next year it cuts back to 80%, and then the following year it cuts back to 60, and then 40, and then 20. Now, we don't know what's going to happen over the next years. Somebody, Congress may decide they want to extend it or put it back in place. We'll see. But as of right now, nobody has done that. And so we are looking at the cutoff of the 31st of this year as the final day for 100% bonus depreciation. So that's one thing that we always like to mention, just so you're aware of it. It's a huge benefit to real estate investors. And basically what it means is about 30 to 35% of the value of a property can be passed through as depreciation loss. So if you buy a $10 million property, generally speaking, $3 million can be passed through as depreciation. Now, depreciation is an expense, a tax expense. It's not a cash expense, but it's a tax expense that essentially creates a tax loss. And so that's where the benefit comes in, because it basically means that you can, as a passive investor, have 5 to 7, maybe even up to 10 years of tax-free distributions. So if you're invested in a project with us and you're getting a monthly check of distributions, it basically means that 5, 7, maybe even more than that years of tax-free distributions on your investment. So it's a tremendous benefit, because normally in a situation like that, you'd be paying taxes on those distributions. The other thing that's kind of cool is, and this is a little bit of a side tangent here, but in our investment strategy and our philosophy, when we sell a property, which would normally, again, trigger a taxable event, we do what's called a 1031 exchange. Now, we didn't have a slide on here to talk about that 1031 exchange, but that is the second component of really pushing the tax burden down the road, and it makes us extremely tax efficient. And a 1031 exchange basically says, hey, you've got some gains built into this property, you made a bunch of money, but as long as you reinvest that money in another income producing property or another multifamily investment, you will not have to pay capital gains. So if you think about it, you invest $100,000, your $100,000 grows to $200,000 over a 5-year period. You then can take that $200,000, don't pay any taxes on it, reinvest it in the next deal. It goes to $400,000, don't pay any taxes on it, reinvest it in the next deal. It goes to $800,000. I mean, you can imagine how powerful that compounding is, as opposed to investing $100,000, going to $200,000, having to pay 30%. Now you're back to 140, and then you do that again. It's a big difference. So again, I mentioned that as a little bit of a tangent here, but that's our strategy on how to really maximize our tax benefits. Now, one question that we have a lot is, what does it look like and how do I get these tax benefits? For those of you who have not invested in passive investment like this, you will receive something called a Schedule K-1. Now, if you invested in a REIT or some public type structure, this is different. So when you invest in a syndication, you are invested in a piece of the LLC that owns the actual property. So you are technically a true partner or a member in that LLC. It's a direct investment. There is no middleman. There are no brokerages or investment advisors between you and the investment. So you will directly receive a K1 from us, and that K1 will have your pro rata share of income and expenses. Now, this is where the bonus depreciation comes into play, because that bonus depreciation, which creates a tax loss at the property level, is now going to get passed through to you. So you're going to have a negative K1 on your probably first 5 to 6 years of your investment in the property. And that negative K1 can then be applied to your 1040 return, or if you're invested in through a business, your 1065 or your 1120S or whatever it is. So that loss gets passed through to you, and then you can utilize that. And there are different ways that it can be utilized. That depends on your individual tax situation. But worst case, if you can't utilize it yourself, and there's a lot of different rules that go into that, you are able to carry that forward and apply it to future gains in that property. And that's where I said, even if you can't utilize it immediately, it will allow you to have 5, 7, maybe even more years of tax-free distributions because of that. So again, it's a huge benefit, a really awesome tax advantage of investing in multifamily real estate, and basically gives you the ability to invest your money and grow it compounded without paying any tax. I don't want to say any taxes, because there are some taxes that are due at some point, but it's very minimal. I like to say that it's 98% tax efficient, because it's very, very tax efficient. So anyway, kind of coming back to what I said at the beginning of the presentation, we'd rather do a 16% investment, or an investment that returns 16% a year, and keep 100% of it at a little bit lower risk profile, versus trying to get that 20% return and then pay a bunch of taxes and actually end up, with a lower return. That's our thought process. Utilize the tools that we have to maximize our return. So we have a couple questions here too that thought would be useful to answer. And again, that actually reminds me, I completely neglected to do a little housekeeping here. So, and you guys may have already seen some questions come through, but there is a question box at the bottom of your screen. So if you do have questions as we're going along, plug them in there and we will try to answer them. If not, we'll get to them at the end of the presentation, but that's what it's there for. So as we're going along, if you're thinking, man, I have no idea what these guys are talking about, I need some more information, put your question in there. Don't worry, there's no dumb questions, and we'll make sure to answer them.
And then Robert, real quick.
Yeah, go ahead, John.
Yeah, I just want to say thanks a lot to the folks that entered in some of these great questions as they registered for the event too.
Yes, absolutely. That was great to get some questions ahead of time. So first question here was just, will I receive deductions in 2022 if I am investing before the end of the year with REM Capital? Yes. So as long as your investment's received by December 31st, you will receive those K1 tax losses through the accelerated depreciation when you receive your K1 by March 15th of 2023. And you'll be able to then pass that through to, personal, business, whatever return you're filing it with. Can you explain what happens when a property sells and there's depreciation recapture? Well, right now, if we sold a property and there was depreciation recapture, there would be a tax on that depreciation recapture. However, if we have a property that rolls via a 1031 exchange, then we will be able to defer those taxes as we go forward. So again, the property is essentially structured in such a way that we are taking into consideration all the different tax implications as we roll those funds into the next deal. So we're very sensitive to the tax situation. And again, right now, that's how it works. Down the road, it could change in a few years. We'll see, because these things do change as different administrations, take over the Congress and decide they want to make things better or worse, depending on, where we're at. But that's how it works currently. So depreciation recapture is definitely something that we think about, because it could trigger a pretty significant tax burden. But again, that's where the 1031 exchange comes into play. Next question is, what if I don't use my depreciation loss for my 22 taxes? A lot of people don't use them immediately, but which is fine. Those depreciation losses will carry forward. So 23, 24, 25, you got plenty of time to use those depreciation tax losses. And again, they can be applied regardless of your real estate status, because there are some rules around, whether somebody's a real estate professional, et cetera. And again, you can ask your CPA about that stuff. But if you have other real estate gains, passive gains in another investment like this, you would be able to also offset those gains with any losses that we pass through to you. So let's just say you've got another property that's making a lot of money. We can actually help you offset those gains and lower your tax burden for 2022, as an example. Now, I know a lot of you guys are newer to the business, or you have minimal gains from properties, but some of you have pretty significant gains in your properties from tax, making money on those properties. So this is a great way to lower that tax burden while also continuing to keep your investment dollars rolling forward. So a couple of things there. Last question we have here is, what potential tax benefits are available for passive investors? Kind of alluded to that. It really depends on your individual tax situation. So check with your CPA and make sure you understand your individual scenario. There are several. There are kind of different categories that the IRS puts people into depending on what involvement they have in a real estate deal. And again, like I mentioned, if you've got other income that's coming through from other properties, you can most likely offset that with tax losses that you receive from investments in a deal like REM. So there's lots of different things there. But in general, I always like to tell people that worst case, you're able to take advantage of those tax losses, at least within the investment. And that's where the 5 to 7 years of tax-free distributions and then the rolling of the capital gains tax is part of our plan. But again, I would just say you probably you can probably get more than that depending on your individual situation. So always good to check with your CPA, because these things are very dependent. I know everybody hates it when CPAs say that, but it really depends on your individual situation. The tax law, as you know, is not simple. It's extremely complicated and frustrating, but it's job security for CPAs. So it is what it is. All right. So hopefully that helps answer your questions. Again, if you have other questions, feel free to jump in. Adam, yes. Sorry.
How many pages are we up to on the tax code?
Yeah, too many. Although I have to say, there are some good things. And so our job is to whittle out those tax laws that benefit what we do, spend the time hiring a good CPA to advise us, and then take advantage of those. So, that's always been my policy. Play the game, just know the rules really well. All right. So what have we been up to? A lot of you guys have followed us along for the last few months, but we've had a busy second half of the year. We closed 5 deals, and we've got basically 2 in San Antonio, 1 in Orlando, and a couple in the Atlanta area that we closed in the last few months. These were deals that we've had under contract for, quite a few months, actually. We were able to negotiate them down as the interest rates were increasing. So that worked out pretty well for us. We were also able to immediately begin to see some upside in these properties as we closed them. We just closed the Orlando deal today. So excited to have the last one completed. Woo! Yes, I know. Yay.
12:35.
What's that?
12:35.
12:35. Wait,
Today.
what's 12:35?
That's when we closed. 12:35.
Oh, 12. Yes, right. Got it. Okay.
Not that Adam was counting.
Not that I was constantly refreshing.
Not that Adam was counting down that one. Yeah, that was a little brutal on that side. And just as a side note, guys, right now the lending market is, I would say, a little bit in a defensive position. There are people lending, obviously, but I think a lot of folks are a little concerned about the economy. They're a little concerned about where things are headed. And this is my take on the whole situation. If you look at the fundamentals of our business, supply and demand, where rental rates are going, where income is going, everything is pointing in the right direction. I mean, literally everything. we've got 5 million units that are underbuilt. I mean, we need 5 million more units of housing in this country just to accommodate the demand that's there. That 5 million is not going to get built anytime soon. In fact, this downturn is going to push that even further along because there's going to be more people that are going to pull back and say, I'm a little concerned about what's going on. So that's one benefit for us. The second thing is that if you looked at the recent economic data, wage growth was up 5% in 2022. And I don't think it's going to slow down. Now, some people point to that as a problem because of inflation, et cetera, et cetera. I don't look at it that way, and I don't think the Fed does either. In fact, they came out middle of this year and basically said, we need to allow wage growth to grow because in order for folks to be able to afford things, there needs to be some wage growth. Wage growth has been underperforming for the better part of 20 years. So again, we're finally seeing some wage growth. We are also seeing a lot of movement in terms of people really wanting to move from what I would call a lower end workforce housing to a nicer product. They don't want to pay A-class rents, but they want a nicer product, which is exactly the niche where we are. Basically taking older product, renovating it, and then bringing it back to market. Obviously, it costs more, but it's significantly less than somebody having to go to a Class A property. So from a fundamental standpoint, our business is in a great place. Now, some people say, well, that's great, but you're having to pay a lot more for your interest. And obviously we have a lot, 60 to 70% of our purchase price is a loan. And that's true. But here's how I'm looking at it. If you're able to get a $5 to $7 million discount on your price versus a year ago, same asset, same area, great location, great opportunity, fundamentals of the business are the same, and you get a $5 to $7 million discount on your purchase price, what's it going to cost you in interest in order to complete that project versus what you would have paid a year ago? So your interest costs would have been lower, very true, but you would have paid a lot more for the purchase price of the property. Now our purchase price is $5 to $7 million less, as an example, on most of our deals. But what are we paying in interest costs? Well, according to my analysis, we're going to spend probably somewhere in the neighborhood of $500,000 to $1 million in additional interest cost because of the higher interest rates. So here's what I'm thinking. Fundamentals are phenomenal. Supply and demand is still where we want it to be. People are still demanding these units, willing to pay the rent, and they're growing their income so that they can afford the rent. And we are now going to spend an extra $1 million, $500,000 to $1 million in interest cost, but we just picked up $5 to $7 million of potential upside. Now, I don't know about you, but even if it takes us 10 years to get there, that's a 10x return on our investment. And I don't think it's going to take us 10 years to get there. I think it'll be more like 5, maybe 7 at the worst case. So again, we're kind of looking at it and saying, hey, if we're going to invest $500,000 to get 5 million over a 5 to 7 year period, that's an absolute no-brainer. So again, it's a little bit contrarian, but we look at these things as investments. We look at the full picture, and we really believe in the fundamental business model that we're seeing. Now, again, in order to capture those opportunities, you have to be well-funded. You have to be liquid. You have to know what you're doing. So again, if you're going into this with $2 in your pocket, probably not going to work out because right now the economy is a little up and down. But if you go in with 6, 12, 18 months of working capital set aside, plus some savings in the bank on the side to back that up, you're probably going to be okay. And that's kind of the way we look at it. And based on my experience of at least 2 downturns that I've been through in my career, I've seen how people have not only made it through, but they've profited through these downturns. So again, that's our scenario. There's some talk out there that, the world's going to fall apart and everything's going to sell for 30 cents on the dollar. My thought is this. If the world falls apart and things are selling for 30 cents on the dollar, we got a lot bigger problems to worry about. I don't think that's going to happen. And if you look at where the debt level is relative to the equity that's built into these properties, it's completely different than 2008, 2009. So we don't think that's going to happen. There's going to be a correction. Absolutely. We're already seeing that. We're taking advantage of those opportunities, and that's where we are today. So again, not to belabor the point, but just some thoughts to keep in mind with regard to where we're at today. So as I mentioned, we do have one particular property that we still have a little bit of room left. And a lot of people have said, well, you know, it must be the worst property because nobody wants to invest in it. And it's actually kind of funny because we had these 4 deals that were basically back to back. We didn't plan it that way. We actually planned to close one a month. But as things happen in this business, and luck would have it, you know, one gets extended and the other one closes on time, and all of a sudden they kind of all clump up. So we ended up actually raising the capital for each deal on a very short time frame. And we had some that we had to go back and backfill. We actually closed Avenue 33 first. So that one we had the most amount of time to go back and kind of catch up. I think we got 1 or 2 spots there left. But basically that one's done. And then City Park was the next one. And we had a very short window to get all the capital put together. So we basically did as much as we could. And then we said, okay, great. We got to flip over to San Antonio and then got to flip over to Orlando. So it was a pretty tight time frame. And again, you know, a lot going on. It's pretty rapid growth for us. So we're trying to keep up with the capital. So it has nothing to do with the fact that it's a bad deal. In fact, it's a really cool deal. And I'm going to share a little bit about what we've seen just in the month that we've owned it, which I think will get you pretty excited about it. I certainly am. But anyway, so I just wanted to mention that. I left the disclaimer slide in here. You know, this is a Q&A webinar. It's a little bit different, but basically this is just our sort of standard disclaimer that this is a investment offering for accredited investors. It does, you know, everybody can hang out here on the webinar and check it out, but we just have to let you know that it is a SEC non-registered 506C offering. So anyway, just technical stuff. All right, so getting back to the City Park deal. So our initial projections for what we thought we could do were basically, you know, if you look at the renovation rent premiums there at the top of your screen, we are at average in place $917 for a 1-bedroom, average in place for a 2-bedroom, $1,008, average in place for a 3-bedroom, $1,090. That's where we bought the property. We felt like we could do some light renovations, bump it from there, and then a full renovation, we could get even more than that. So again, that was based on the comps in the market and us being pretty conservative about those rent premiums and wanting to be careful in terms of, you know, making sure that we could hit those numbers. Now, those numbers backed into our overall model, gave us some good returns. And again, that's why we wanted to do the deal, because it's in a great area. We love Atlanta. There's lots of growth happening in Atlanta. In fact, Atlanta has actually been one of the most resilient markets for both job and wage growth in the country. And right now, as you guys probably know, places like Phoenix, John's hometown of Boise, Idaho, Salt Lake, some of those markets, they're kind of getting hammered from a rent decrease standpoint. And you know, it'll be fine. They'll make it through. It's not the end of the world, but they're getting pretty hammered. Atlanta is not. In fact, Atlanta's been very steady and true to the last couple of downturns. We don't really expect to see a whole lot of declines in the rent market for Atlanta. So anyway, it's a solid market. It's going to continue to grow. It's on the I-85 growth corridor in the southeast. Lots of manufacturing, distribution, technology. You name it, it's kind of got everything. It's a great place to be. So really the only challenge with Atlanta, in particular the county where we're located here, is that you've got some backup from evictions, and there are quite a few evictions. But we're kind of used to that, because whenever we buy a property, we're going through and reprofiling that property with the right folks that pay their rent on time, have the income, qualify, et cetera, et cetera. So we expect that. And obviously, once we get that completed, we're not going to need to go through and have the eviction process as consistently as we do now. So anyway, so bottom line is that's what we projected based on the comps in the area. And, that kind of gave us our business plan. Now, I talked a little bit about conservative financing earlier when I was talking about the risk-based model. So here's some specifics to kind of let you chew on. So in this particular deal, we've got a 68% loan-to-value loan, very low relative to, kind of what what some folks would consider normal leverage of 70, 75, 80%. So 68%. Now that's loan to value. We're putting about $2.5 million into it. So that's from a loan to cost standpoint, it's going to be even lower than that. Again, we try to keep it in that 60, 70% range. So it's right in that range. So it's pretty low loan to value. We've got a 5-year loan on it, 3 years plus two 12-month extensions, full term interest only. So we've got some pretty good terms there. We were able to actually do pretty well in the loan, given the interest rate market. The only painful part is that these days, when you purchase what's called a rate cap, which essentially locks in your interest rate, those are pretty expensive. So it took a good chunk of change to purchase that interest rate cap. But again, from a risk standpoint, we don't want to be left sort of hanging out in the wind just in case the Fed does decide to continue raising these rates a lot. We need to be protected. So that was really the only painful part of this particular project. But again, it goes into that cost of the cost of doing a deal in today's market versus the profit that we're going to get on the back end. Now, on the bottom here, you'll see our conservative underwriting kind of ties into the additional 6 months of operating reserves, $1.4 million. We stress tested our break-even occupancy. And the other thing we've done in terms of a return standpoint is we've kind of said, let's not model that the cap rate or the valuation in the market is going to stay the same. Let's model that it is going to actually get worse. Now, I don't think in 5 years that it's going to be worse, but you never know. So let's be conservative. Let's take the sort of the worst case scenario and see how that plays out. So that's what we did. Those are the numbers that are factored into our overall return. Again, I don't think that's going to be the case. I think in 5 years, we're going to be back in a good spot. The economy is going to, go through its sort of corrective period and then get back on a good path, but we never know. But that's part of our conservative underwriting. So all that being said, kind of the stress testing, the interest, all these different components play into these projected returns. And I think it's important, and the reason we like to talk about the underwriting before we talk about the returns is because returns are very easy to manipulate one way or another. It's very easy to take projections and move things around and make everything look good. We don't want to do that. We'd rather be very realistic about it, be conservative, and ensure that what you're getting at the end of the day is a realistic projection of what should happen, even in a average market. Now, it's easy for anybody to hit the returns when the market's just going crazy like it's been for the last 10 years. What happens when you hit a bump in the road like we're seeing right now? Can you still hit these returns? That's really what we're wanting to project. So that we're kind of able to say, here's what we expect to happen over the next 5 to 10 years. So we have a 8% preferred return on this deal, an average of a 10 to 12% projected cash and cash return. Now that's an average over 5 years. It always starts off a little lower because, we buy the property, start going through that renovation process, and then it bumps up. Usually the first year, 4 to 6%, then it kind of bumps up 2% to about 2% every year as we do the turnaround. Projected IRR, 15-18%. Again, that's roughly a double in 5 to 7 years. That's kind of a standard for us. We like to double our money every 5 to 7 years on a conservative basis. Now, we sold a property earlier this year that had a 23% IRR. So again, we're trying to make sure that we are under promising and over delivering at the end of the day. But that's our projection here. Investment term is 5 to 10 years. Now, I can't guarantee you that it's going to be 5 or 10. The point is it's a long-term investment, and we want to make sure that we set that expectation appropriately because this is more focused on the cash flow and the tax, not advantage, but just the tax efficiency of the deal. So let's just say we buy a deal 3 years from now, we have a ton of equity built up into it, and we have the opportunity to roll that money into another deal that has a lot of potential upside. Well, we'd probably sell that property because we could 1031 the money, roll it in the next deal, and everybody's happy. On the flip side, if we've got a deal that's kicking out, 12, 13% cash on cash every single month, and there's no other deal that makes sense, well, we're probably going to hang on to it for a little longer because that's a phenomenal return. And we certainly like mailbox money. So anyway, just to give you a little bit of a background there. Now, I've got a note down here at the bottom talking about preferred return. Some of you that may be a little bit of a newer term for you. Basically, what that means is that the investors in the deal get at least 8%. That's kind of our guarantee. It's not a guarantee. That's a minimum that the investors will receive before the sponsor receives anything. Now, we all have money invested in the deal, so we're part of that investor equity. But there's also a sponsor promote, is what it's called, a promote. It basically says, look, if we as the managers do better than 8%, then we get some bonus. If we don't do 8%, we don't get anything. And we kind of did that because we felt like, hey, that's a minimum commitment from us to you, saying, look, we want to make sure that we're incentivized appropriately to at least hit that preferred return in order for us to get that promote on the back end. So that's kind of the way that works. Real quick on the business plan, which I kind of alluded to, there's kind of three components here on this particular deal. Below market rent that we're moving to market. There's plenty of upside there just because of management and getting the right people in the units, being friendly, being good with maintenance, making sure that people are qualified, just basic property management 101. That's sort of step one. Step two is upside in our unit count. We actually have a building that's been, it was burned down years ago, the slab left there. So we built into our CapEx budget, we're going to rebuild it. And it's permitted for 8 units. We think we might be able to get 12, maybe even more than that, rebuilt into that same exact pad. So that's basically free upside for us. And I'll talk a little bit more about that in a minute. And in the current unit condition, we want to take those units, renovate them, bring them up to a nice B plus class property. And we're going to get even more upside on our rent because of that. Because like I said, people really appreciate those renovated units. This is kind of a cool little, it's nice to see where the property is located, what it looks like. The yellow star there is actually where the brand new building will be built. It's right towards the front of the property, right across from the clubhouse and the leasing office. So nice location. It's going to help us from a traffic standpoint too, because obviously you put some pictures out there of a brand new building and you're going to get lots of traffic. So, understandably the rent's going to be more than the other units. But it is going to be kind of nice to have that momentum going for us as we build it out over the next year. So what does it look like for you? As I mentioned, in the first year, we anticipate kind of in that 4 to 6% range. Our projection here is 5.1. Year 2 bumps up another couple points. Year 3, 7. And then what happens in year 4 is it really jumps up a lot. Now, let me explain kind of the thought process here. Our goal is take the first 2 years, complete the renovation. Let's say it takes a little bit longer than we thought. Okay, maybe it's 2.5, 3 years. At the end of that renovation process, we want to go back to the lender and say, hey, we've added a lot of value to this property. We're now at, 45% leverage. That's a little lower than we'd like to be. It's great, but we'd like to take some of that capital out, reinvest it. So that's where year 3 comes in. And our plan is to do a refinance, which would get a $76,000 plus or minus amount of check back to you. So if you invested $100,000, you're going to get your distributions, and then year 3, you'll get this $76,000 check. Now, the idea behind this is twofold. Number one, you are essentially deleveraging your investment. So at that point, you'd have $96,000 of your $100,000 back in your pocket. So you've almost essentially doubled your money in 3 years. Now our goal is to double it in 5, which is, if we could do it shorter, that's great. But our goal is make sure that you get all your capital back. The second thing is what we hope you'll do is take that money and reinvest it. So if you think about it from a cash flow perspective, you're now getting cash flow off of 2 properties with the same investment dollars. You didn't have to do anything. You literally invested them in one deal. 3 years later, you got a big check back, you reinvest it. Now you've got 2 properties that are giving you distributions. Just imagine what happens as you do that every 3 to 5 years. It's really powerful. So that's what that 3-year refinance is. And then, of course, year 4 and 5. In this case, the projection is we sell it in year 5 just so we can kind of have an idea how it looks. There's a profit, there's a return of initial investment, and then the cash on cash returns as well. So that's what it would look like. That's our projected returns for City Park. And here's where it gets exciting. So over the last month, as we've gotten in there and we have started to manage the property, we are way ahead of our schedule. Now, again, like I mentioned, we do like to under promise and over deliver, but this is pretty cool. So average in place when we bought the property, $917 for a 1-bedroom. We are currently renting a non-renovated unit. Haven't touched it, just cleaned it, turned it. We're currently renting that at $1,200. That's about a $300 upside. We haven't done anything to it. So again, that's just bringing it to market. Second, 2-bedroom, we're renting that at $1,355. That's over a $300 premium for that 2-bedroom. 3-bedroom, we're at $1,500. That's a $410 premium. Now, if you take that, just that alone, let's just take $300, okay? No renovations, no nothing. $300 over 208 units, because there's 208 units in the property, not including the new units that are going to be built. That $300 rent bump equates to a $750,000 additional income. Now, if you put a conservative valuation on that, meaning, not crazy 4-cap stuff that's happened in the last couple of years, conservative 6%, which is pretty conservative for Atlanta. That's a $12 million value increase just by doing that alone. Now, I want you to think about this. What does that mean? Well, right now, our total equity in the project is about $15 million. So we've essentially almost doubled our money just by bumping those units to market rent. Now, obviously, it hasn't happened yet. It's going to take us time to work through every single unit. But the point is, that's how this works, and it's pretty cool. The second thing I wanted to mention is the units that we're bringing online for this building that's not built, that we're going to rebuild. It takes us about a year to do that. But if you take the profit or the income that's going to generate, it's about a $4 to $6 million value that we're going to be adding. So again, that's another, call it 30% that we've added just by putting that building. So again, you can kind of see how these upsides work and the valuation gets increased, and how we can really profit from buying the right product in the right place with the right upside. So anyway, I wanted to bring that to you. It's exciting for me to see it. Not completely surprising. Again, we try to be conservative and try to outperform what we want to do, but it's always nice to see that. So anyway, wanted to bring this to you guys, to your attention. This is an opportunity that's still available. Would love to have you on it. And it's still available for 2022. So obviously any investment that comes in before the 31st of December would get the accelerated depreciation, which is a nice tax benefit in addition to some good solid monthly cash flow. So that's a wrap. I'm sure we've got some questions. So John, I'll kind of turn it over to you at this point.
Surprisingly, Robert, we don't have any questions right now. If you do, go ahead and place it. But that was a pretty great presentation, Robert, and covered a lot of bases there. So
hope we didn't lose everybody on the tax minutia. It's all good stuff, though. It's all good.
Oh, Bob Gruber asks, is the end of year investment minimum still $100,000?
Yes, it is. And Bob, just so you kind of understand our thought process, we value relationships more than a single transaction. So what I've told people is I said, listen, if you're new to us and you're looking at a long-term relationship building, we would value that, and we would be willing to talk to you about, working something out. Basically, what I've done in the past, I've had people say, hey, listen, I've got $100,000 to invest, but I'd like to spread it out over a couple of deals. Can I do that? Sure, no problem. We value the long-term relationship. We always support asset diversification. So there are some exceptions to the rule. The reason that we set that minimum investment is kind of because we don't want to be the crowdfunding model. We really do value the relationships of each investor. I don't want to say that we want to make it, super exclusive. It's not like $1 million minimum, but at the same time, we do want to make sure that we've got the time that we can spend to talk with each of you guys. John, myself, Adam, we really think that's important, and we want to continue to do that. So keeping that minimum does help because it lowers the number of people in each deal. And so that's kind of the thought process. It's not necessarily a totally hard and fast rule, but we try to make sure that there's some good thought process that goes into that. So anyway, hope that answers your question. But
great. And then one more. on a 100K investment, what would the depreciation look like from Richard?
Yeah, great question. And I'm sorry I didn't answer that earlier. So typically on a 100,000 investment, there's going to be about a $70,000, maybe $80,000 tax loss the first year. Depends on the property. Some are a little bit more, some are less, but usually it's right in that range. And I think City Park, as an example, will be pretty close to that for 2022. And that, it doesn't matter if you've got $1 million investment, it'll kick off a $700,000 to $800,000 tax loss. So it's call it 70 to 80% tax loss in year one. Year two, you still have a certain pretty decent depreciation benefit, but it drops quite a bit at that point. Usually it's 10, maybe 15% in year two. So year one's the big one. But anyway, to answer your question, kind of in that 70 to 80% range.
Awesome. Okay, well, I think that's all we have. And this is going to be our last presentation for 2022. It's been a heck of a year at REM Capital, and we appreciate everybody.
Absolutely. Thank you, guys. Great to have you, and hope you have a wonderful holiday. We will see you in 2023. Take care.
Thanks all.